Hello, hello.
Hey, sweetheart.
Can you hear me okay?
I
We,
can. I
we
can.
forgot to, we were having connection issues, so we forgot to check levels and whatnot. So if you
Yeah,
can't hear us, let us know.
might be one of those days.
You just don't know. We've got, a track record here for connectivity issues. So we're going to just do our best. We want to start off by just the summary of this kind of a part two from last live stream. Hey, Celeste, thanks for tuning in. Uh, this is just really important that we talk about the power of information because in the last live stream, we helped a viewer get eliminate 50 over $51,000 in debt, and we showed you how to do it in less than 16 months.
Right.
Now we had to find leverage, right? And everyone's situation is unique, so this was where this person's leverage is. But really the power was in information. That's the only difference between what they can do over this next 16 months and what they had been doing for a really long time. And so that's just what I want to highlight is how important it is to be able to level up by getting educated. And that's what we're here. That's hopefully what we're all here to do, right?
Absolutely. And there's some things that, there's some things that just simply rubbed me a certain way, right? It was like, golly, in order to find a debt tool or create a debt tool, we had to first eliminate the fact that there was negative cash flow in play. And again, you cannot do velocity banking without positive cash flow. So we had to create a situation where we had to inject some cash to be able to create a positive cash flow situation, which required us to eliminate a retirement account to do so.
Yeah. And we
And
both felt very different about that.
Absolutely. And I want to start this off with, I am not a financial advisor. I am not a tax attorney. This is not financial advice. This is absolutely my perspective, approach, opinion on how to eliminate debt. Now, the fact that it works is the fact that it works. That's just math. But the moral of the story is it is not a small decision to make to take your retirement account, deplete it, to eliminate debt, to put yourself in a much more positive cash flow position, to then all of a sudden turn around and then rebuild your retirement, because that's what we're doing today. Today, we are going to rebuild the retirement with the fact that we've eliminated $51,000 of debt in less than 16 months.
Yeah. Celeste says that really hit home for her. Here, we'll put her comment up. She says, this is pretty much where she's at. And absolutely, yes, let's go. She's ready.
Okay.
So she said, this is a mind shift. Um, Sri, thanks for joining us. We see you over there and our LinkedIn friends. Um, the power of information is really where it is, and it is a mind shift, right, Celeste? It's absolutely just the lack of what we don't know.
Right.
That's what it is. You say it all the time. We don't know what we don't know, and so we continue on with the information that we do have, trying to do our best.
Right.
Now, we did feel differently about this, and I do want to address this part again because while you're focused on disclaimers and math, this is more like a wake up call for me. This is the come to Jesus for me. It's this retirement plan wasn't a plan.
Right.
This is the fail to plan to fail type of situation where this person wasn't failing to plan necessarily. The plan was going to fail regardless
Right. Right.
because it doesn't work.
What?
So,
And there's a level of
I get that
conditioning.
you feel that way, but I just don't. I feel like we've come up with an actual solution where the HR department would have just let this person continue on like this until they had come up against their retirement, or they something happened in their life for their health and they couldn't work anymore, and they said, okay, well, let's take a look at that retirement because I put in what everyone said I should put in every
Right.
single month, and now here I am at that ripe old age, and they go, oh, yeah, sorry you didn't win. Like, if this isn't a game, this isn't a maybe you get to. This should be a plan, and you should absolutely have a know that where you're getting off. That's how I
Absolutely.
feel about it.
Well, not only that, this because this also is not the fault of the person either, because there's
Right.
conditioning here.
Right.
Meaning, we've all been conditioned to believe a certain way about how where we're supposed to put money and what that money is supposed to do for us over time, and the position we're supposed to be placed in once that money matures. And
Yeah.
so, the contributing to a retirement account when I am 50 plus $1,000, 80 plus $1,000 in debt. We've been conditioned to believe that's what we're supposed to do, right? When in fact, there's a whole lot of pieces and points here that need to be addressed before we basically putting ourselves in a much more positive cash flow position before we can take action, because all we're doing is robbing Peter to pay Paul. And you're right, the vehicles that are available to the average American to be able to prepare for retirement, those vehicles are flawed, and we're not taught about the flaws within those vehicles. And because the vehicles are flawed, it causes us to put money in a place where it doesn't serve us in the long run. So
Yeah, right. Okay, so you want to do a summary real quick and head over to the vibe board?
yep, and I'll do the summary from the vibe board. So let's go
Okay,
from there.
cool.
Yep, and yeah, I was wondering which one you were going to use. So let's see here. So give me a minute to
It's like
maneuver.
a roulette game. You just
Right.
don't know
All
where we're
right.
gonna go.
So in essence, a couple days ago we were talking about velocity banking, and again, the what we were able to do was eliminate $51,000 of debt in less than 16 months. So just to remind everyone as to what velocity banking is, it's where you take a debt tool, your money comes into your checking account, and from your checking account, that cash flow, all of that money, all of your check goes onto a debt tool. And when the money goes onto that debt tool, it puts your let me do something real quick. Should have done this earlier. Once you put that money on that debt tool, it puts you in a position to now pay bills from the tool. And when you pay bills from the debt tool, all of your cash flow ends up living on the tool that you use to pay debt from. Now, the challenge is, okay, I can put my money in my checking account and I can identify a debt tool. The question is, hey, can I pay all my bills from it? And that can be a challenge, but ultimately that is the concept behind velocity banking. And with your cash flow living on your debt tool over time, it pays down the balance on that debt tool, which puts you in a much more positive cash flow position because you are in essence using the same dollar multiple times. The I guess the big picture piece around velocity banking is getting multiple uses out of the same dollar, because we've been conditioned to believe once dollar goes towards a bill, that's it. We have zero access to that dollar once it goes towards that bill. But using this process allows us to get multiple uses out of the same dollar, which allows us to attack multiple bills at the same time. Looking at this gentleman's situation, there was a total of about 80,000 in debt total that we had realized was actually in play. But we were able to eliminate 51,000 of it within that 16-month period. What we did was we didn't address this balance during the first 16 months. And if you add these two together, it's about $30,000. So hence 30,000 from 80 leaves us the remaining debt here that we were able to address over that 16-month period. These are the monthly payments associated with those debts. And we ended up using this PLOC here, this line of credit. There's some pretty cool tools that were available for this gentleman. This PLOC that's in play. There's another line of credit that's in play. There's a couple of IBC policies that do have cash value on them. And even if push came to shove, there's this Navy credit card here with a limit of $21,000. If we didn't have this line of credit, didn't have these IBC policies, this credit card with a credit limit of 21,000 would have been what we used to eliminate this debt. And then also I want to acknowledge also the interest rates over here to the left that we were able to get rid of without going all the way through everything again. Just wanted to kind of quickly recap what occurred. Again, at month zero, we took $20,500 that was sitting between a 401k and a couple of IRAs and withdrew all of the money from them. At age 59, so this individual is 59 years of age. So at age 59, there's no penalty as a result of that withdrawal, but we absolutely have to pay tax on that 20,000. In paying taxes on that 20,000, there's about a $5,000 tax that would be required to be paid at the end of the year. And then these IBC policies, there was a total of about maybe 8 grand between all of the IBC policies, and we to be able to attack the first bill, we ended up borrowing 5,000 from between those two policies. So between the 14,000 or 15,000 that was withdrawn out of the 401k after the penalty, we added another 5,000. So there was a total of about 20,000 available to us. And so we immediately had taken that 20,000 to pay off this Navy card. Why is that? Well, kind of go back here to see it. That Navy card had about a $20,500 balance on it. And it was this card at $520 a month and 18% interest that it made sense to get rid of, because it gave us an influx of $520 in cash flow, and allowed us to get out of a negative cash flow position, which is what we were in when we started. In addition, we paused payments on the IBC policies.
And why we do that?
Well, and a lot of people don't, well, it depends on the type of policies you have. I actually have a security mutual policy, and that was one of the policies that was used, that this gentleman has. And as a result, I don't think I'm, there we go. And as a result, we did pause policies of about $1,871. The reason for pausing those policies is again, we were in a negative cash flow position at month zero. We were negative about $1,200, over $1,200. And so to put us in a positive cash flow position to be able to attack debt, we depleted the retirement account to get rid of that Navy card, and we paused payments of about, again, what, 1,500 and 371, so about 1,871. We paused payments for about 1,871 to at least get us 3 months of cash flow to attack some other debts. And so that was the whole point of doing that. And that is a rider that's actually built inside of my security mutual policy. I don't have access to this gentleman's security mutual policy. So my assumption is he would have the same capability. So I just kind of made that assumption in doing this process. So,
But a lot of people don't know that. Again, the
right,
power of information.
right, absolutely. And so in pausing those payments during month 1 through month 4, that allowed us to attack some debt. And that's kind of what this shows. So we started up here with a lot of debt and a couple of IBC policies. And with that injection of $20,000, we were able to pay off that Navy Federal. And in the process, over the next 4 months, we were able to address the AMG card, the loan, and the first PLOC. And in the span of, I think in total, it took us 4 months in total to get rid of this PLOC. But the bottom line is, within those first 3 or 4 months, we were able to address a large amount of the debt that was in play. And then from month 6 on, it was really about addressing one last credit card and reducing the amount of the balance that was accumulated on the lines of credit, because the lines of credit happen to be our debt tool. So once we put all of this debt onto this debt tool, then the last step was to eliminate that. And finally, we reintroduced those IBC premiums. And so the objective at that point was to become whole inside of the IBC policy. So that's ultimately how or what was done to, I guess, eliminate that $51,000 of debt. Again, starting at month 0, we took some action. Between months 3 and 4, we eliminated, I'll call it 75% of the debt. And then from month 4 through month 16, it allowed us to be able to get to a point where only debt that was left were those IBC policies.
Okay, I'm gonna change this back real quick.
No problem.
So I think that this is a great place to introduce, or to, at least to ask, when we had to make the decision to eliminate the retirement account in order to kind of dive in and scoop this person out of this, which thank goodness they had it, right, to be able to leverage.
Right.
But it was $20,000. And let's say that at age 59, having 20, how much should they have by age 59 in order for this to be considered something that that would actually help them retire?
So I have to back into that number. So there's going to be a lot of words.
Okay.
So here's kind of how I back into this number. I had assessed with cash flow of about 5342 is what the monthly cash, oh, not, I'm sorry, not monthly cash flow. That's her, the income. Monthly income was about 5342 monthly going into the debt tool. So
Okay.
based off after tax, after the amount that was going into his checking account at month one of 5342, based off that dollar amount, working backwards, 5342 times 12 is about 60 grand. You throw in 20% of taxes on top of that. I'd assess that the annual income for this gentleman was right around 100K, maybe 96, 97, 98, 100K a year. Okay, so if they're making 100K a year, I have to assume the objective is to retire with 100K a year. Meaning, I don't want to retire with less than what I already have. So if they're
Right.
making six figures, then the objective is to retire with six figures. So if I'm 59 years old, what do I need at retirement age in order to achieve a six-figure income? Well, if I'm going to retire at the standard 65, in order to have a six-figure income, I need at least 1.5 million. I'm sorry, 2.5 million. Not doing my math right. I would need to have at least 2.5 million inside of my 401k in order to be able to retire with a six-figure income. Okay, so where do I get that from? If you were to go to Vanguard, Fidelity, Morgan Stanley, any of your traditional retirement institutions, they use this thing called the Trinity Study, and out of that became the 4% rule, which says this: the max you can take into retirement should be 4% of your nest egg. And that's so that you don't run out of money in retirement. So if 4% of your nest egg needs to be $100,000, 4% of 2.5 million is how you get $100,000 a year in income. So in order to achieve retirement at age 65 of $100,000 every year, you would need at least 2.5 million. Having $20,500 at age 59 is a long ways away from having 2.5 million by age 65. So what that means is 65 is not realistic. So you push that out to 72. Maybe you push that out to 75. Still, at age 59, we're talking another 14, 15 years to be able to achieve a $2.5 million nest egg inside of a traditional IRA. I think there were two of them, two traditional IRAs and a company 401k. That is a significant gap to fill using traditional retirement accounts. Does that answer the question? That's, like I mentioned, a lot of words.
Yeah. So by the time they went to retire, which we're going to just say age 70, let's just call it age 70 ish.
Mm-hmm.
Most people are saying
72, 73, 74.
it would
Mm-hmm.
be super great if it was before then, but let's just say age 70. They were age 59 and had 20,000.
Yep.
So where you were feeling like this is a tough conversation going in, I think I do understand the toughness about this, but the toughness really should be in dealing with the fact that we're none of us are ready.
Right.
None of
Right.
us have had what we need in order to be ready and be prepared until this point. And so, well, most of us.
Right.
Okay. So now, regardless of how you do the math, no matter how you slice it or dice it, going down this road was not going to help this person. But I think there's another side to this. Does eliminating the debt help this person?
Right.
Is it
And
is it eliminate debt and then like that's part of the conversation that I feel like a lot of people are having when they're watching this particular series because they're going, yeah, 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 I want to eliminate my debt and then I'll start a retirement plan.
so what we were able to do is I came up with three scenarios. There's probably a million scenarios, million different scenarios we can identify. But what I kind of laid out was three scenarios where what if we at month zero we started contributing to a retirement, because again we had to deplete the retirement and start over. So what if month zero we started right back up building that retirement? What if, in another scenario, I think it was more like we didn't start immediately, we addressed some debt, But then during the middle of during the midst of eliminating that debt, we started. And then I think the last one was, what if we just waited till the end and started at the end once we eliminated the 50 or $80,000 worth of debt and jumped in. So there's many different areas, many different perspectives you can have on this. I don't know that any of them are easy. And I think the other piece that I just want to note here is, if the actual amount starting in month zero inside of a retirement account for a 59-year-old is $20,000, what is a realistic, I'll call it, goal using the $20,000 that's available? Because I backed into that one as well. And here's what I mean. I had concluded, based off having $20,000 in a retirement account, that they're probably putting away somewhere around $500 a month. So if they're doing that, they're on path to achieving what by age 65 or 72 or 75. And that dollar amount is somewhere around maybe 450, maybe a half a million dollars. And when you do the math on how much income is that, it's $20,000 a year in income. So the current retirement account, if we do nothing, if we did nothing with that 401k and allowed it to continue to build how it is, it would accumulate or achieve about $20,000 in income, was the other part of this. So
Yeah, but they would find out, they
wouldn't
would
find that
find
out
that out
when
at
it's too
the
late.
end.
Right. When it's
Yeah.
too late. When it's too late.
But
Absolutely.
but the other part of this is, um that also may not be the case, because it's you're subjected to market risk.
That's right.
That's the
That's right.
part that just is like market risk, and then on top of that, taxes.
Again, there's layers to this. There's
Yeah,
levels
so
to it.
so
There's
you want to
so
show
many
them
pieces here.
so you want to show them what you came up with, because I think, one, it is just, again, the theme here, the party we're throwing for tonight on this stream is the power of information. Power of information.
The more you know.
Yeah. So let's get into it, because I want them to be able to see what it is you
Yep.
came up with. You want to finish your
Yep.
summary real quick?
Yep. Let's do
Okay.
it. All right. So ultimately, what this visual is saying is, it's a combination of the debt and how the cash flow increased as we eliminated debt. So as we eliminated debt, as we got rid of Navy, as we paused payments, as we paid off other debt, our cash flow started to increase. And there's this point where the cash flow has reached a point where the debt is almost being easily eliminated because there's so much cash flow available to be able to do so. So the bottom line is, there's this point where we intersect, and at that point, that's where many actions can be taken. Meaning, it's kind of hard to focus on anything other than getting rid of bills when you're sitting here. When you're sitting here, okay, you've created some room. You've created some room between zero and where you are as far as cash flow, to be able to maybe interject some cash into a retirement plan or whatever the case may be. But when you start to eliminate that debt, it's game on. There's nothing left to do here but focus on what the future looks like, because this debt is gone. And so there were a few different scenarios that we came up with, and this is the first one that we kind of walked through, and that is, what if, instead of, once we eliminated that 401k and took that lump sum to be able to pay down that Navy card, and paused payments for 3 months, that gave us an influx of cash. And what if, after those first 3 months, because during the first 3 months, again, if you remember, during the first 3 months, one, two, three, during the first 3 months, we were able to eliminate some debt. So because we were able to eliminate some debt, there is an influx of cash. So as a result of there being an influx of cash, what if we took $500 and put it into a secure compound interest account? What would this look like if that was the case? Take $500, put it into a secure compound interest account, and allowed that to compound till age 72. Well, you would accumulate it right around $10,000 a year annually, tax free for the rest of your life. So that $500 at age 59, that $500 till age 72, would allow you to achieve right around $10,000 tax free. Well, once the debt was addressed, and that's kind of what this looks like from from month 3 till right around month 156, till age 62. So at this point, Once all of this debt has been addressed, we have cash flow available to us to go do some things with. Well, because we have cash flow available to us, let's now be a bit more aggressive. And what is that cash flow we have? Well, once all of this debt is addressed, we now have paid back what we owed to both of these IBC policies, which means at a minimum, there should be somewhere between 30, I guess I need to come over here some. At a minimum, there should be somewhere between 35 and let's say maybe 45K available to be able to be used for something else. And so, which means we should have the ability to leverage a lump sum to be able to get that compounding. And so, if we're able to do so from age 62 to age 72, so from age 62 to 72, there's about at least a minimum of $30,000 available plus the 1871 that we're currently contributing to be able to start a secure compound interest account. So if we at a minimum start at $500 a month from age 59 to 72 plus this 1871 from age 62 to 72, what would that do? Well, inside a secure compound interest account, that would produce for us right around $42,000 tax free for life. Now, these are my words, but let me show you. And hopefully, internet will be nice to me.
We have a question.
I'm listening.
If you want to wait?
No, no, I'm listening.
Okay. It's from Celeste. She says, wouldn't you have to pay the 401k loan back, and would this reduce your income? So I think maybe just
Yep.
to clarify, if anybody else has questions about this process too, it's probably best to just ask him now before he moves forward.
Yep, and that's a great question. And also, sweetheart, just so you know, I want to move over to the calculator as well. But that's a great question because the assumption here is that we took a loan from the 401k to be able to address that that Navy credit card debt at the start, and it wasn't a loan. And that's which is why this is such a, I'll call it a not a simple task to even articulate. We withdrew, we eliminated, we canceled, we obliterated. I don't know what word you want to use, but we took all of the money out of that 401k and those IRAs. So we took $20,000 out, and in doing so, there's nothing left. And so it wasn't a loan. We didn't borrow. It was a withdrawal. And with that withdrawal, it caused a tax event. So gentlemen would end up being taxed and penalized on that $20,000. And I equated that tax to be somewhere around $5,000. So this was not a loan. So there's nothing to pay back because once we take this money out, there's nothing left. And in addition, you might wonder where this $500 a month comes from initially. Well, in my math said, in order to achieve $20,000 inside of that 401k in the amount of time that it was done, the contribution amount is somewhere around $500 a month that was going into that 401k. So when I depleted the 401k, there's a $500 a month, I'll call it influx of cash. Well, it's not really 500 because when you do that, that means your taxable income goes up, which means it's something less than 500. But I assessed it as if I was putting 500 in my 401k, now I'm going to start here and take that same $500 and start a secure compound interest account. So good question. Any
Yep,
others?
yep. Nope. That's it for now.
Okay. So what I was basically saying was at current age of 59, what we want to do is take, and 59 till 72, take $500 and start compounding, meaning we have depleted the original retirement account, so there's nothing in it. And now we're going to take $500 once that cash flow starts and start contributing. So $500 inside of a secure compound interest account, what would that do? Well, yeah. So that would allow for about 10K. Oh, of course I would. Hold on one moment. So that ends up being about 10K in income annually. That's this dollar amount. And it equates to about a nest egg or a cash value of about 114K. So these are the $2 amounts. And maybe since I'm bouncing back and forth, you might want to show the full picture. Otherwise, you'll have to be swinging back and forth.
Yep. Got it.
I'll wait for you.
Boom. Done.
Perfect. So, in essence, what I was saying was, so if you starting the account now, there's that $10,000 annually that's available to you, and that $500 a month equates to about 10,000. So there's your 10,000. And then starting at age 62, because you now have more cash flow available to you, we will then, from age 62, so once the debt has been paid down, not necessarily paid off, but paid down from age 62 to 72, you have available at least at minimum 30,000. There should be more, but I'm saying at minimum 30,000. And in addition, we're no longer paying the 1871 into these policies. What I'm saying is we're going to 1035 exchange and move that 1871 that we were paying from in those old policies over to a secure compound interest account, which equates to about $31,000, $31,000, 31.5 maybe, $31,000 as an income annually and a nest egg of about 335,000. One other thing to note here, there's a death benefit associated with this as well. If something were to happen to him, he would be leaving his beneficiaries about 1.2 million. So in eliminating a 401k, with that doesn't really have a true death benefit, in eliminating a 401k at month zero and taking two approaches, taking $500 and putting that away for from age 59 to 72, and starting at age 62, putting away 1871 for the next 10 years, allowed us, in combination of these two actions, to achieve 42,000 tax-free for life. And in total, that death benefit would be somewhere around, because there's an additional 114,000, I think, which would equate to a total death benefit of around, let's call it about 1.3 million in death benefit between these two policies. And again, so show me the 401k that could come close to any of that.
Yeah, and in order for you to be able to opt in for a life insurance policy, you'd be splitting up your funds so it would have less impact
Right.
for you. Yeah.
And in addition, I think you bring up something that's important as well. You can't just haphazardly shut down your 401k and jump right into a secure compound interest account. But there are some actions here that were already in play, which tells me this person can absolutely do it. They already have two IBC policies, which means at age 59, they've already been approved for life insurance, which means they have a certain amount of, I'll call it insurable interest available or insurability available. So what we're doing is taking advantage of that insurability they already have. So they already have two policies worth in total, probably $200,000-300,000, and all we're doing is moving those two policies that they've already been approved for into a secure compound interest account. That's a penalty-free, tax-free transfer as well. So because we're just simply moving the two policies they had into this, there's not additional actions involved. And again, things can change between age 59 and 62, so health can change. But because we're moving these permanent policies over, there's no, I'll call it, there's no reevaluation of health that would be required, because we're taking policies that already existed and moving them into a secure compound interest account, if that makes sense.
But look what you've done already. Just in the first option, what you had just laid out for us before was that the best case scenario was that this person was set up to get 20,000 a year,
Right.
but that's going to be taxed
Right.
on top of that because of the 4% rule. And now, in the same amount of time, just by restructuring differently, again, the power of information. That's right. This person is now able to at least double not just double what it is that they'll be able to get per year, but in addition to that, now they have also leverage that in the cash value part of this policy and the death benefit. So there's just wins all over here, and this it just, again, so important that we're out here talking and needs to be shared out. Okay, I'll
And
let you go back.
And don't forget, that's $42,000 a year plus Social Security. So again, I don't think I'm hitting anywhere close to that $100,000 a year that we would like, but we are 50% greater, 50% more than what it seemed as though would originally be there if they were using the standard retirement account that was available. And
Probably
so,
more because of the
right,
taxes.
right. And so the second option, let's see here. The second option that I identified was okay. Instead of, and this is somewhat unique as well, because words matter. Instead of starting at month zero, what we're going to do is surrender the IBC policies. So there's a lot here. So what do I mean? So for that, I want to come over here. Let's talk about these policies a little bit. I've got a $6,600 balance on this Penn Mutual and a $22,000, almost $23,000 balance on the Security Mutual. And these balances are loans, meaning this is about 30K due. And these monthly payments of 371 and 1500 are not making a dent in that $30,000, meaning these are just the premiums due on the policies. There is nothing extra or additional. If you're only paying these premiums, that does not pay the balance that's due on those loans. So the thought process was, what if instead of addressing the $30,000 that was due, we just surrendered the policy? What that means is we're canceling. We're letting the policy lapse. We're not going to, and I'm not suggesting this. I'm just saying, what if we no longer make another monthly contribution and we let that policy lapse? That means all of those 1871s a month that was done in the years prior, we lose. Like it's a waste. There's no death benefit left. We surrender the policies. Well, what happens if you surrender a policy? Well, the IRS is going to come along and say you will lose all of the tax advantages associated with those policies. So therefore, they're going to say that $30,000 that you still owe, that's now becoming a taxable event. Well, it's not all a taxable event because the money you've used to contribute to this policy, a certain amount of that you've already paid tax on. So there is a difference between the amount that you've put in and the amount that you have left over, the amount that you owe, that you're going to owe taxes on. And I'd assess that amount at being about, let's call it 7K. So there's about a 7K tax liability associated with surrendering these two policies. But if the two policies are surrendered, what does that mean? Well, if you surrender these two policies, meaning you cancel these two policies, there's $1,871 a month that is now available. There's $1,871 a month in cash flow that you can now use to go eliminate debt. As I kind of mentioned a couple days ago when we started this example, what you're going to hear from me are non-traditional approaches. This is a non-traditional approach to attacking debt. So, coming back over here. So in doing so, starting at age 59, starting at age, which is month zero, starting at month zero, we're going to surrender that $30,000 balance that we owe on those two IBC policies, which is going to cause a taxable event. And then in addition, starting in month zero, we're going to then take that 1871 and for the first year, so from age 59 to age 60, so from age 59 to age 60, right about here. So from here to here, we're going to use that 1871 to attack this debt. And then at age 60, we're going to take that 1871. So we're going to give it a year. We're going to take that 1871 plus the $500 that we are no longer putting in our 401k, meaning this option assumes we did everything else from option one, everything else from the original attacking of debt, the depleting of the 401k, we did all of that the same. The step that's different here is instead of pausing payments for 3 months on the IBC policies, we just let them surrender. So if we did everything else the same, surrendered the policies, took the monthly payments from those policies plus what was going into the 401k, and at age 60 started a secure compound interest account, what would happen? Well, the debt payoff, instead of it being 16 months like it was in the original example, it becomes 19 months. So it takes us an additional 4 months to get rid of that $51,000 in debt. That's the biggest change here. But after that, everything else is going towards income. Everything else is building a retirement. And so you take that 1871 plus 500, dump it into a secure compound interest account, and let's see what happens. And so from there, let's jump into this calculator and let me show you what I mean. So again, we didn't do anything at age 59. We started at age 60. At age 60 till age 72, there's no lump sum. There's no lump sum available because we surrendered the policy. So there's no lump sum there to even have access to. We took all the monthly payments, 1871, plus that 500. So 500 plus 1871 would give us a total of 2371. So at minimum, we're taking, I think the cash flow shift was about a $4,000 cash flow shift. So what we're saying is we're taking a little bit more than half that cash flow starting at age 60 and dumping it into a secure compound interest account. So if we take that 2371 and do so, what happens? Well, by age 72, we're talking about an income of about $41,000 tax free, 41.5. We're talking about cash value of about 480,000, almost a $500,000 of cash value available. And again, God forbid something were to happen to him, we're talking about a death benefit. We're talking about a death benefit of about 1.3 million. Again, had he done nothing and just continued his normal path, show me a 401k that can accomplish any of that. It's just not going to happen. And so again, from age 60 to age 72, putting away 2371 monthly would allow inside of a secure compound interest account. And we can dig into why a secure compound interest account does what it does, but just taking this for face value that these are facts, you would be able to achieve about $41,000 tax free and a nest egg of about 480,000. About 480,000 in cash value. So cash value about 480K and a death benefit of about 1.3. Any questions about that?
Nope, no questions so far.
So from here, so again, the first approach was we are taking some small action at month one, using about $500 a month to get started, then pay down some bills. And then by age 62, we're going to hit this thing hard. In the second example, it was, okay, maybe we don't start a secure compound interest up front, but we take a drastic measure to not only eliminate the retirement account, but we're going to take a drastic measure to eliminate the bill associated with the life insurance as well. So we're going to surrender the policy, pay whatever the negative impact is from doing so, but that frees up cash flow for us to attack debt aggressively. And then at the end of the first year, so after 12 months of doing so, we immediately jump into a secure compound interest account, and we're still able to build somewhere around that same, I'll call it $40,000 a year.
Well, I have a question.
Yes.
Because when you compare some of these policies, like why would you suggest somebody let go of their like whole life or cash value policy? Because obviously this person is putting in like what was it, 1,800
Right.
a
Right.
month into this
Right.
policy. I mean, they were pretty aggressive, but that's an aggressive approach, right? Like strategy. That's a lot of income. So here's my question. When you put an MPI policy next to this cash value policy, why does it make their old policy look like dial-up internet?
I think it's very simple. Because if let's say they had an IUL, I think the greatest comparison you can compare MPI to is just a regular IUL. Let's say they were doing this 1871 inside of an IUL and did the exact same timing. So from age 60 to 72, got an IUL from Prudential, got an IUL from someone selling Prime America, got an IUL from wherever, and
Yeah.
it was structured properly. Like it was everything that I scream about, structure and making sure that it's properly designed so that it produce the most efficient income. Let's say you did that exact same thing. Well, an IUL is okay at producing income. The difference between an IUL and a product like MPI is leverage, is the use of other people's money to help your money grow faster. When you introduce leverage, when you introduce other people's money into this process, it creates an effect of your money making its own money, but also the money you're leveraging is making money. So you're making money in two places. I
Mm,
kind of started this as the whole objective is to get multiple uses out of a dollar.
yeah.
MPI is a vehicle that allows you to get multiple uses out of a dollar because your money's making money, but then the money that you're leveraging is also making money. And you put those two things together, what ends up happening is you end up creating income at twice the pace. So
Yeah.
again, using this same example inside of an IUL would probably somewhere around $20,000 a year in income, meaning comparable to what you could do with your 401k. But when you add leverage, it allows for that income to double, which means it's why it's showing more like $40,000 inside of a product like MPI.
Which is still not enough because it in 15 years from now or 20 years from now, with inflation and the cost of living and healthcare expenses and all the things that we have to consider,
Mm-hmm.
that's the part that we don't have any control over. And that's the part that we have to plan for, are the things that we don't have control over, because saying that it's not fair doesn't make it any better.
Right.
Realizing or having it acknowledged that it's not going to be fair does not make it any better dealing with that type of situation. And some of those people are dealing with it today in this day and age, because what they had planned for was back in the 70s and 80s and even in the 90s, and now they're just now retiring going, this market sucks. I don't like it. Not a vibe. 0 stars. Do not recommend that you retire with this economy. And
Well, and
they don't have a choice.
I go back to conditioning. It's conditioning, meaning no one's when we took that job with that Fortune 500 company and they gave us this stack of paperwork to fill out to start doing your 401k. No one stood at the front of the room and said, this vehicle that you're about to start contributing to blindly is not efficient. No one said
Yeah.
that.
And
So we
nobody was sitting in the room going, yes,
r-
401k
right,
meeting. Let's
right.
go.
So we were there to receive information. We were there to be coached. We were there to be guided, and we were guided into this situation. We were coached into this situation.
Yeah.
Why is that? Because the people guiding us and coaching us have something that they are trying to achieve here. And it is not in our best interest, but we don't know these things. So therefore we head down this path and don't realize this path is impacting us in a detrimental fashion because again, there's no one standing on the outside going, hey, there's a better way.
Yeah. All right. We have from Phyllis. She wants to see a lump sum. So we can definitely do that. Phyllis, what lump sum would you like to put in and see? Just put that in the comments real quick and we'll.
Yep. So and here's all I need. So I got your age already. What is a goal? If the goal is a dollar amount on an annual basis, I can help you back into that. Or if you've got a lump sum that you want to put forward, absolutely show me and I can show you what that would look like over time. But also understand this, and I'm gonna put us in the same category because we are above that age of 50. We don't have as many compound cycles. So when you're wanting to put in a lump sum and see what that will do, you also have to realize you have to give your money time. This is not Bitcoin. It doesn't happen quickly. It takes a while for those compound cycles to kick in. So keep that into consideration as well. Um, so
There's a little bit of a delay. So while
mhm.
she's putting in whatever that lump sum would be, just make one up and then you can fix it when she puts it in.
Yep. So at age 60,
Oh, she said 250K. Oh,
perfect.
she's got a term policy due to expire in about 2 years.
Yeah, don't that sucks, right? Because I ran into the same situation. You have your term policy that in case something happens to you, okay, cool. But when it expires, you realize I spent 20 years funding this thing and I've got nothing out of it. So
Yeah.
yeah, trust me, I get it. So
They don't
age
even they
60,
don't even throw a party for you.
right? Age 60 to 72 with a lump sum of 250. And just so you know, this calculator will automatically split your 250,000 in half. I have the ability to stop that. I just can't stop it using this calculator. So there's an assumption that that 250 would be 125 in year one, 125 in year two. The reason I say that is if you're able to put 250 all in at one time, you're going to actually have more income available. I won't say double, but somewhere between double what you're going to see and only doing half that. So somewhere in between there is what that actual dollar amount will be. And monthly contributions, are we using the same 2371? Because if that was the case, we're talking almost a millionaire. We're talking 950,000 in cash value available, and we're talking 107,000 tax free for the rest of your life. And because of that lump sum, it caused a significant impact to the death benefit. We're talking about a death benefit of around 3.6 million if God forbid something were to happen to you after the age of 72.
Okay,
Yes.
I have a 15 and 20-year-old wanted to build generational wealth. Well done, Phyllis.
Okay. So we're talking about two different things there. One is either it's a policy on Phyllis herself, or it's a policy on her 20 and on the 20-year-olds, which would be something separate. What I'm showing here is if at a six as a 60-year-old you were to start contributing to a secure compound interest account, dump 250 in, and again I was continuing the 2371 a month. That can absolutely be back down some. But if you were to follow that same scenario, that's what we're talking about, the $100,000 a year in income. If you were to just do the 250 alone, here, I'll show you what that looks like.
It could be a policy on all three.
Absolutely.
Yeah.
There's a way to make this work, but let me just show you what specifically $200,000, $250,000 one time lump sum would produce for you over this 12-year period. Over that 12-year period, we're talking about $66,000 tax free for life based off a one time contribution of $250,000. And so, regardless of what that monthly contribution would be, we're talking $1,000 a month. You put away $1,000 a month. We're talking $83,000 tax free for life. So there's just so much play here, so much room here, so much growth available because that lump sum was introduced. There's just a lot of opportunity here.
She said, "Wow."
Right.
Yeah.
Right, because you and well, and here I've got the side by side comparison. That $250,000 lump sum, $1,000 a month. What does that look like if you were to do a traditional retirement account? Notice there's more. There's more in a 401k. There's more in an IRA than would be in this secure compound interest account. You have almost $300,000 more here than here. But look at the difference in income. This is a taxable $37,000 a year. This is a tax free $83,000 a year. There is no comparison.
That's
Now, if
crazy.
you were sitting in front of a financial advisor, they would try to tell you that 900,000 is better than 600,000. That's actually a true statement. But what they don't tell you is how much income can you get out of that? How much income does that translate to? The income is the part that should make your head explode. You're telling me I've got 300,000, almost $300,000 more, but it's almost a third, well, half. It's less than half of what I'm able to produce having $300,000 less. Like the math, it just doesn't make any sense. But that's absolutely what's happening here, and it's because one is a withdrawal and one is a distribution. Is what makes this different.
I have a question.
Yes.
If so, on the topic, like what Phyllis's situation is, because I think this is a great example, actually, where someone is trying, their whole objective is to create generational wealth. And sometimes it goes, okay, but I'm going to use me. Sometimes that does make sense. Sometimes it makes sense to start building their own machines. So
Right.
Phyllis can have a machine. They 15-year-old can have a machine, 20-year-old can have a machine,
Absolutely.
because they have more compounding cycles available to them. The product that they would be able to get would be cheaper to insure them than someone who is older. And I do understand that part of it. But what would be the benefit to only doing, like, building Phyllis a machine versus building all three of them a machine?
So, and I think kind of peeling those layers back is key. So let's say we just focused here. What does focusing here do? Well, it's kind of that analogy of the planes going down. Who do you put the oxygen mask on first? You put it on yourself before you put it on your kids.
Yeah.
This is no different. Meaning, if addressing this policy first does what? Well, not only does it put you in a position of being able to generate income and having a decent retirement in the form of 83,000 and a nest egg of about 672,000 in cash, but in addition to that, if something were to happen to you, there's a $2.9 million payout going to your beneficiaries. Well, who are your beneficiaries? That's that 15 and that 20-year-old. So not only did you live a decent life with a decent income well into retirement, didn't become a burden on your kids, God forbid when something happened to you, you passed on a nest egg of $2.9 million. So if you just focused on yourself, that's pretty powerful.
Yeah.
But let's say you didn't. Let's say you maybe did something a bit more modest for yourself. Let's say you took 100,000 for you, and we can keep the $1,000 a month maybe. So we're talking about $44,000 tax free for yourself, a cash value of about 390,000. Like that's not too bad. So again, a bit more modest. Well, for your 20-year-old, you said, you know what? Because my 20-year-old does have more time, and these numbers are a little bit there's some rules that would have to be clear to be able to do this. But hypothetically, if we were to take $100,000 of that 250, and you can drop this down to, let's call it $100 a month. Take that $100,000 lump sum for a 20-year-old and allow 25 years for that to compound. Because the 20-year-old has more compound cycles, you've just made your 20-year-old a millionaire by dumping in that lump sum, allowing them to take $120,000 tax-free for life by age 45. So we talk about generational wealth. You've now placed your 20-year-old in a position to now decide when they want to retire or identify how to go do their purpose. So instead of working from a job and expecting that job to be able to be that vehicle that gets them into retirement, you've now set that 20-year-old up to have choices, to have decisions.
And become their own bank.
Absolutely. And looking at that 15-year-old, so you would have what? So 100,000 for you, 100,000 for your 20-year-old,
Oh,
and for your 15-year-old, you got 50 grand left.
she has a question. What if I put lump sum of each for each of them 50K?
Yep. So here, let me go back to the 20-year-old first.
Okay.
So 20-year-old,
Yep.
and I'm going to play this out a little bit longer just because I know the 50,000. So let's call it 55. And you take, and again, remember this calculator. This calculator is going to split that 50,000 in half. So it's 25 year one, 25 year two. Again, age 20 to 55, a one-time lump sum, and again, a modest $100 a month equates to 152,000 before she would even legally be able to retire from a 40-hour-a-week job. $152,000 tax-free for the rest of the life. That's a nest egg. That's cash value of 1.5 million. And God forbid if something were to happen to them, there's a death benefit payout of well over 3 million.
Dang.
Again, show me the company 401k that can come close. And
Yeah. Well,
so,
well,
go ahead.
can you talk about the leverage, like the become your own bank? Because I
Yeah.
know that we've been
Yep.
talking a lot about velocity banking, but infinite banking is the next step, and this is the vehicle for that. So,
Yep. So the assumption here is this is a vehicle that's being designed or being used as retirement. I tell people that I'm a retirement planner, but I always drop the retirement income planner, but I always drop the word retirement. I'm an income planner, meaning my objective here is to put you in a position where you can generate income. Let's take this 20-year-old as an example. This is assuming they wait till 55 to touch their money, but no one said they had to. What does it look like after 10 years? So by age 30, what's available? Well, obviously no one Not too many people can retire off $13,000 a year, so I'm not suggesting that. But there's this cash value that's been created over that 10-year period that gives them $114,000 of cash value. What can be done with that $114,000? I'm 30 years old. My life's just getting started. Maybe I'm in a relationship, so about to have children, and we need a bigger place. Man, wouldn't it be nice if I had some type of savings or some type of account that had a lump sum that would allow me to assist us in purchasing a home? Well, you've got a savings account with $114,000 in it, and there's no one standing over you saying what you should or shouldn't do with this cash. It's available to you. So if you were to take, let's call it 50K, and go put that down as a down payment on your dream home and move into your dream home, you can do it from here. And because you're leveraging that 50,000 to be able to do so, this 114,000 is still working for you. Meaning you're using this money to go, build a dream home, buy a car, pay a bill, whatever you used it for, but you didn't withdraw it from this dollar amount. You leveraged it. And so therefore this 115 is still working for you. And so over the next, let's call it, say you're in that home another 10 years. By age 40, that nest egg has grown to double, if not more. So now you have a nest egg of about 358,000. And 10 years ago, you used that 50 grand to go, again, build your dream home. You leveraged it, which means there's a interest rate owed on the money that you're using. But so what? Let's say you decide to pay some of that interest back or you don't. Like what happens? What is the end result because you've leveraged this money? Because you're in an account that's structured properly, all that ultimately means is you could begin to pay a certain amount of that back now. Meaning if you borrowed 50,000, used it for 10 years and you owe, let's say 60,000, you could pay off 80% of it right now if you wanted to. Or let's say you didn't. And let's say you allowed this to compound another 10 years. You haven't paid a dime on that $50,000 that you borrowed 20 years ago. And let's say that 50,000 ballooned to 80,000. Well, guess what? You now have 100,000 in tax-free income that you could take to pay that off, meaning you have more than enough cash available to you to be able to address whatever it cost you to use that money. And in addition, you've got a nest egg, you've got cash value available to you of almost $1 million. But let's say at this point, you never addressed that 50,000 you borrowed, and God forbid something happened to you. If something were to happen to you right here, there's a $2.4 million payout to your beneficiaries. And if you never addressed that $50,000 loan that you took 20 years ago that maybe you now owe $100,000 on, the life insurance company is going to take $100,000 out of this 2.4 million. So before your beneficiaries receive 2.4, they'd receive more like 2.3 because $100,000 payback had gone to the life insurance company to address that loan. My point to all of that is, who cares? Because at the end of the day, there's enough structure and enough growth inside your policy to pay for any opportunity that you might have or that might come about. So I think that's the power of a product like this. And notice the age. We're saying by age 50. Show me the IRA, 401k, 403b, TSP, government 457 plan that will allow you to leverage or do any of this without being taxed and penalized on it. Just doesn't exist. And again, that's what makes this product powerful.
Yeah. Wow.
A lot of words. Did I answer the question?
Yeah. Well, I think you definitely answered the question above and beyond, of course. And I think that's the power of information, because most people don't even know that they can leverage it in this way, though, to become their own bank or to make moves like this. So
Yep.
to your point, you want to buy a house, that's one thing. But what if it's you could happen to roll up on this investment property or this, this
Right.
what we call the baby house, right?
Right. Right.
And your house buys its own house, or your policy is buying other things, and you're able to leverage, because in those moments when you can identify opportunities, being able to take advantage of them is just as important as being able to even identify where your opportunities are and are not. So
Right.
that's
And
that's the part for me.
and coming back full circle to this example, how do you do any of this if you don't have cash flow available? It
Right.
starts with generating and creating cash flow.
Yeah,
You
we have a
get you
question.
get you get- okay, but you build that cash flow. You create a situation where you are no longer robbing Peter to pay Paul. You introduce cash flow, and then you have to go find somewhere to put that money to work. Cash flow is your employee. You are a business owner. Your job is to make sure you put those employees to work. So where are you going to put that cash flow so that it's generating more cash flow for you passively? And then the objective is once that cash flow is generating passive income for you, you get to fire your job. You get to replace your job with this cash flow, with this income that this cash flow that you've identified is now producing for you. And so now you become the CEO of this business that is doing nothing for you other than building income passively. Like that's the objective here. The whole
Yeah.
purpose of velocity banking isn't just to eliminate debt. Me personally, I don't want you to pay off your home. Me personally, I don't want you to be debt free. What I want you to do is be able to generate and build enough cash flow to be able to put that away passively so it generates enough income so you can go fire your employer rather. What's the question?
Okay. And yeah, I'll save my thoughts because I definitely want to get her question. She said um I'm new to your channel. I was
Mhm.
looking at whole life as well. Are
Yep.
there any guarantees?
So great question. And I get this a lot. So now what we're talking about is what is the difference between a whole life and this secure compound interest account that I'm referencing? So I want to again a lot of words. I prefer to set the stage around cash value life insurance products first. And I don't even think we need the screen to do that. I just want to set the stage around cash value life insurance products first. So there are many different types of permanent life insurance. There's whole life policies, there's variable life policies, there's index universal life policies, there's a lot. Most people who do infinite banking and a lot of the, I'll call it the influencers you're seeing online are talking a lot about whole life policies. Why? It's because of infinite banking. Most people who sell whole life policies are promoting infinite banking. But what most people don't realize is infinite banking is just a concept. The concept is using whole life policies to do it. So, what's the selling point behind whole life policies? Why is a whole life policy a great tool? Usually, the selling point around a whole life policy is guaranteed growth. There are very few products out there that will offer, that will even allow the words guarantee to even be used. Most whole life policies, if structured properly, produce on average somewhere between 3 and 5% guaranteed annually. If you have guaranteed growth, that means you have guaranteed income. You allow that guaranteed growth to produce that guaranteed growth for a right amount of time. You have income that's available to you for life. Like, how awesome is that? Well, here's the problem with whole life policies. In order to use the money inside your whole life policy, you have to borrow against the policy. You have to use what's called the participating loan. Anytime you introduce a word loan, that word loan implies there's a cost to borrowing that money. So if you have a whole life policy, let's use real numbers. Let's say you've got a whole life policy and you're able to borrow $50,000 from that policy to go pay a bill or do an investment. In a poorly designed policy, the cost of borrowing that loan is somewhere around 6, 7, 8, 9, 10, 12%. So let's think about what I just said. You have a policy that's making, on average, 4%. It costs you 6% to use the money. This is the piece that they don't talk about when they talk about infinite banking. If you're borrowing money that's making 4%, but it costs you 6, it's every time you use a dollar, it's costing you 2% to use that dollar, right? You made 4, it's making 4, it cost you 6, the difference is 2%. Where's that? So how does that 2% impact you? What that means is if you don't pay that loan back, that 2% deficit is starting to eat into your cash value. which is why anyone who educates people around infinite banking usually says, hey, make sure you pay that loan back. If you're going to bank on yourself, make sure you treat your bank as you would if you were borrowing money from Bank of America. That means if you're going to borrow 50,000 at 6%, make sure you pay that $50,000 back at that same 6%. They're saying that so that you put your policy back whole so that you don't start to eat into that cash value. The truth behind that statement is it's a poorly designed policy. If the policy was efficient, not only would you be able to take that $50,000 and go do a deal and make money, but your policy itself would be making money as well. So yes, there is a guaranteed 4% growth inside of a whole life policy. That's awesome. But to use your money, it costs you. That makes that product inefficient. And so therefore, if you don't treat it properly, if you don't take the right action, you will find yourself in a hole similar to this gentleman that we did this example on. They've been taking policies year after year, paying bills, but because they didn't pay back those policies, put themselves in a position where now they have a $30,000 deficit, $30,000 balance due on all the money that was leveraged. Okay, so that's whole life. What makes this product different? What makes MPI or secure compound interest account like MPI different? Okay, well, inside of MPI, if you look at the structure of MPI, it's an IUL, an index universal life insurance policy. The foundation of MPI is just an IUL. What are the guarantees inside of an IUL? An IUL does not have guaranteed growth. So if you were to compare a whole life policy to an IUL, that alone says, why would I want an IUL if I've got guaranteed growth inside of my whole life policy? But as I mentioned, the cost to borrow, the inefficiencies of the policies are the problem inside of a whole life policy. Well, inside of an IUL, there's no guaranteed growth, but there's this little thing called a 0% floor. That 0% floor is guaranteed. So there's no guarantee on the growth. The guarantee is because of this 0% floor, there is a contractual guarantee that you can't lose money as a result of market risk. Which is better, guaranteed growth or the 0% floor? I will argue that the 0% floor is better because your growth isn't limited. It's not guaranteed, but it's not limited. In addition, if this product is structured properly, and because of the use of OPM, other people's money inside of it, I can exponentially grow faster inside of this product. And because I can exponentially grow faster, I can exceed the growth inside of a whole life policy with my eyes closed. And then in addition, the cost to borrow. If I wanted that same $50,000 out of my MPI plan, what does it cost? Well, it costs around the same, about 4%. But here's the problem. Because the growth inside of MPI is on average 7%, and the use of other people's money, that growth is around 10%, it allows you to make money in upwards of around 10, 12, 13, 14, 15%. So inside the policy alone, you're making anywhere from 7 to, let's call it 12, 13%. If you're making 7 to 13% inside the policy, and it costs you 4% to borrowing that money, you're making money on the money that you're borrowing. Meaning if it costs me 4% to borrow and I'm making 7%, there's a 3% arbitrage that's still living in the policy, which means my money's still working for me, my money's still being made. Then you take that money the 50,000 that you borrowed at 4% and go do infinite banking, pay a bill, make an investment, do whatever it is you want to do. And you're making money there too. Let's say you don't pay the loan back. What's the impact? Well, because the money you borrowed is cheaper than what it's making inside the policy, there's no impact there. You've taken this money and you've used it for infinite banking and you're making money on that investment, meaning you took 50,000, cost you 4%, but let's say you bought a rental property and that rental property is making you 8. So you're making money there. And then if you then decided to still pay that money back, in essence, your money is working for you in 3 places as opposed to 2. Again, a lot of words. To sum it up, a whole life policy looks like this. You're making money in 2 places inside your whole life policy. You're making money on the 4% guaranteed. And if you go do infinite banking outside of that whole life policy, you're making money there. But you're losing money as it relates to the cost of borrowing. So you're only making money in two places. Inside of a properly structured IUL in the form of MPI, you're making money in three places. You're making money inside the policy. The cost to borrow the money is so low that you're making money on leveraging that money. And when you go do infinite banking, you're making money there too. So the difference between the two is making money in two places compared to three. To simply answer your question around guarantees, there's no guaranteed growth inside of an IUL, but that 0% floor, again, I will argue all day long that 0% floor is actually better than the guaranteed growth inside of a whole life policy. Hopefully that makes sense. A lot of words.
Yeah, that was a good thorough explanation. So I appreciate the detail in there. Do have a question though, because I sometimes think that it's hard to know what questions to ask, especially when you're in a situation where, like Phyllis is saying, and Celeste too, here on YouTube, and they're looking into insurance products as a way of building their retirement income.
Yep.
So I think this question is something that people may not know to ask. So I'm going to
Yep.
ask it for them. What questions would you ask someone if you're reviewing many different types of products and you're talking to many different types of maybe agents or retirement planners or financial
Yep.
advisors? What questions would be helpful? At least just one question in particular that could help them in kind of assessing what they're looking at and comparing.
Yep. I get this a lot as well.
Oh,
You, did we lose something? Everything all right?
my bandwidth is saying
Oh, it looks like we just lost it. So I did get the question though. So the question was, what is it? What would I tell an individual who was looking at whether or not a whole life or an index universal life made sense?
and then
And
now
I
it's
think in short,
Donnell.
it would look like this.
Okay.
A lot of times when someone is trying to sell you a life insurance product,
Wait,
go ahead.
hold on, because we cut out. So I think you're gonna need to start over.
No problem. So the
Okay.
question was, if someone was interested in some type of cash value life insurance product, what's something that what is a question or what are some questions that can be asked to be able to assess what is the best decision to make? And there's many different ways to approach this. First off, who you're getting a product like this from matters. This has to be someone that understands how cash value life insurance products work and how to structure them. So that's number one. But the easiest thing to do, because most people who sell life insurance are going to come at you with an illustration. They're going to say, hey, here's the reason my whole life policy is great, and here's an illustration for you to review. The first question you should ask when someone puts an illustration in front of you is, when do I break even? And just using simple math, let's say you're putting in $500 a month, which is $6,000 a year. When you put in that $6,000 into your policy, at what point do you have $6,000 working for you? Now, all cash value life insurance products have fees. So when you put in $6,000 in year one, 9 times out of 10, you don't have $6,000 working for you at the end of year one. It's going to be something less than that. It might be 5,500. It might be 5,000. It might be 3,000. It might be 2,000. You can tell a lot about the structure of a policy by how much money is working for you at the end of year one. And okay, you've put in 6,000 in year one. Let's say you've got 5,500 working for you. So clearly you didn't break even. At year two, 6,000 year one, 6,000 year two, total of 12 grand. How much do you have working for you? What I found in the number of whole life policies that I've looked at, and I'd say I've probably looked at maybe 300. I would say 98% of them are structured poorly, meaning the break even point of most of the whole life policies I've seen are somewhere around years maybe 8, 9, 10, maybe 12. Meaning if you're putting in $6,000 a year, it takes 60,000, 10 years of 6,000 before you hit a point where you have 60,000 accessible, available, or working for you. That's unacceptable. In a product that is properly structured, that break even point should be somewhere between years 3 and 5. So if you were to look specifically at maximum premium indexing, MPI, a secure compound interest account like that, the break even point is year 3. meaning you've put in 6,000 in year one, you've put in 6,000 in year two, you've put in 6,000 in year three. By year three, you have 18,000 working for you. More importantly, that's money working for you. How about how much money is accessible? How much money can you use to go do infinite banking? How much money can you use if you needed it? Inside of a secure compound interest account like MPI, that break even point again is year three. Most whole life policies I've seen, not only is the break even point for how much money is working for you, how much money is accessible to you, that break even point is somewhere around year 15, year 20. They are just poorly, they're just not, they don't have the capability to be able to do what it is you want to do. What allows a product like MPI to be able to go leaps beyond other cash value life insurance products is the leverage part. You can call it a match. You can call it premium financing. It has a lot of different words. The moral of the story is you're using other people's money and the arbitrage off that other people's money to help grow your money securely and exponentially, which allows more money available to you at year three to be able to go do different things. So, in short, recap all of that. The easiest thing to do is to ask whoever's providing the life insurance product to you, just ask this very simple question: when do I break even? And if you hear years 10, 11, or 12, you know it's a poorly designed policy, a poorly designed product. You hear 3, 4, and 5, that thing's pretty solid. And in life insurance terms, what that means is if it breaks even somewhere around years 3, 4, 5, you're talking about a max funded, MAX, max funded. Option B as in boy, which means it's um, a fluctuating death benefit, and it's built inside of a properly designed life insurance product. So a max funded option B, properly designed life insurance product is what you're looking at. Hope that answers it.
So yeah, and Celeste said, thanks. That's a good question. So I'm glad that that was helpful. And if you have any other questions, oh, hold on, let's see. Looks like we do have another question. Nope,
Mm-hmm.
it's not coming up. So I don't know. It shows like the indicator, but it's not pulling up. So if you guys want to ask it again, maybe it'll pop up. Um, what is the difference though? Because even if I heard you talking the other day about somebody who had brought to you an IUL, you were comparing like two things, and you were saying if we were to do apples to apples, but we can't actually do apples to apples because there's nothing that compares to this, and here's why. And I
Yep.
think that's also important because to what your point, if that person would have said, oh, well, it breaks even in year 3 or 4, so therefore it's got to be, you know, a good thing, you were going, yeah, but here's the difference, and that was a big difference.
I think I can show you better than I can tell you. I think I can write this out if you want. Um, if you want to slide over to the board, I need a clear space, but I think I can write it out.
Yep, just the full thing.
No, you can do the half.
Okay, there you go.
So we've got an IUL and we've got MPI. What's the difference? And can you hear me okay?
Yep.
So here, I'll make this a little bit. Yeah, that's good. So if we're talking about that again, that $500 a month, $6,000 a year, in years 1, 2, 3, 4, let's go all the way down to year 7. Inside of a traditional IUL, that would be 6K every year. So over that 7-year period, you would have contributed 7 times 6, 42 grand over that 6-year period. Over that 7-year period. The difference between a regular IUL and MPI is just simply leverage. So during that same time period, I'll use a different color. During that same time period, you would have put in the same 6,000 at year 1. You would put in the same 6,000 at year 2. But at year 3, something special would have happened. At year 3, you would have put in 6,000, but the life insurance company would have allowed you to leverage from them all of the cash value from year 1, which means an additional 6,000 would have been added. So simply at year 3, what's different? At year 3, You would have put in 18,000 from in your IUL, but inside of MPI, there's a total of 24K that would have been added to the IUL that is now working for you, that is now building income for you. So at a minimum, at year 3 is where MPI separates itself from a traditional IUL. And so, what your question was related to a client who had come to me and just simply said this: "Hey, I was offered an IUL at my job, and I just wanted to know if the MPI plan that I have is any better." And what I tried to do for him was do a side by side, apples to apples comparison. But here's why you can't. The IUL he showed me, the best that you can do is the growth based off 3 years of $6,000. Whereas inside of MPI, there's an additional amount of leverage being added. And at year 4, it continues. At year four, you would have put in 6K and added another 6K from the life insurance company. But then in year 5, something special happens. At year 5, that 6K that you would have added at year 5, there's 12K of leverage that would have been added. Where did that 12K come from? Well, because we've now proceeded another 2 years, you're able to leverage not just year 1, but you're also able to leverage year 2. So there's 12,000 of additional leverage that you're able to add at year 5. And then in year 6, again, you do the same thing. But then in year 7, again, something special happens. Your 6K now leverages years 1, 2, and 3, which would be 18K. You add up these dollar amounts, you went from, and sorry, this thing is here, but anyway, you went from 42K of leverage in an 42K working for you inside of an IUL to what? 42K plus a certain amount of leverage. That's what, 24, and 18. So 24 and 18, whatever that math is. Another 42K of leverage. So you have doubled the amount working for you inside of MPI compared to a traditional IUL. And again, I would love to do an apples to apples comparison, but there's nothing else like this. And now and just so we're clear, the amount of money you make is not the full complement of this 42,000, meaning you're making on average on your money, you're making on average 7%. So this is no different. In an IUL, you're making on average 7%. The money that you're making here, the growth is 7%, but the money that comes back to you on average is 3%. The reason is because you're borrowing money from the life insurance company. There's a cost to borrow. It cost you 4% to borrow this money. Well, if it cost you 4% and it made 7, you get to keep 3. So in essence, the reason you're making more money here than inside of an IUL is because you have $2 amounts working for you. And that's what makes this different. Does that answer?
Yep. It is so hard when you say it does something special, not to be like, it
I was
is
waiting
so
on it.
hard, but in the moment, I don't want to ruin what it is you're saying.
No, it's all good.
That's what I'm here for. I'm here to press that button and make
So
it
a couple
magical.
things.
Okay. Okay.
We've talked about a lot today. The main
Yes.
objective was to kind of walk through some scenarios where a client who was able to eliminate $51,000 of debt gave him some high level actions, that could be taken to be able to replenish and rebuild their retirement. If there's no other takeaway here, I would just want to make sure that people paying attention to those examples understand this. It is difficult to do velocity banking without cash flow. So you may have to take some drastic measures to be able to create that cash flow. Once that cash flow is created, here's what most of us do. That extra money is sitting in some checking account somewhere waiting to be spent. You have to be able to
Oh,
get your
what
cash
about
flow
high
into a
yield savings
position.
account?
Right. A high yield savings account making you 3%, like awesome. But you have to get your money working for you. Again, treat it as an employee. You have to get your money working for you. Put your money in a position to where it can build money passively. 3% is great, but 11, 12, 13, 14% tax free is much better. Make sense?
Yeah. Can you read the question?
Yep.
Can
Can
anyone
anyone
get
get
an
an MPI
MPI?
plan? MPI is a life insurance product designed to produce income. So anyone who can qualify for a cash value life insurance policy can get an MPI plan. But let's say you can't qualify for an MPI plan, meaning you can't qualify, you personally cannot qualify for life insurance. Can you still get a policy? And the answer is yes, because most of us have this thing called insurable interest. What that means is if you are, I'll use myself as an example. I'm married, father of four. I have insurable interest over my household. So what that means is if I physically am not able to qualify for a cash value life insurance policy, I have the ability to put a policy on my wife. In addition, I have four other people inside this household. So I would have the ability to do a policy on the four other individuals inside this house. And I could own those policies. And when I own those policies, any income generated is income that I have control over. Now, at some point, let's say I'm at an age where I have exhausted, whether it's exhausted my life or exhausted my use of these policies. I have the ability to then transfer them over to the people that the insured that I have these policies on, and then they can continue them on. So it's still a way of building generational wealth, even though I can't qualify for a cash value life insurance policy myself. So can anyone get one? I say there's rules, but the short answer to that question is yes.
Yeah, the high yield interest.
Like your savings account.
Yeah, I saw a post recently and it was like, "Oh, but Apple has a 5%."
Woo-hoo.
And I think the concept here is that people are getting fired up that, hey, if your money is just going to sit there, like you can have it making more money. That sounds great. I think the difference though is if we're just talking about interest rates, it does sound like this is new. This is a different thing to have access to tools and vehicles like this. But the difference is compounding.
Right.
For me, that's the part that I think most people are not adding in this equation when they're talking about interest rates or how their money is growing.
Well, let's be clear. 5% inside of an Apple account is 1,000% better than sitting in a savings account that's yielding 0.01% or 0.1%. So 5% is nothing actually to scoff at. I mean, that's pretty awesome. But to your point, what we're talking about is being able to produce income, not just have a
Hmm.
place where you can park your money and make more than it was currently making. Again, I
Yeah.
go back to money should always be moving. You should be treating your cash as an employee. Just because it's sitting there making 5% doesn't mean you can retire off that 5% in 10 years.
Yeah.
Because it's still building compound interest. It's just compounding at a rate that may not necessarily be able to put you in a position to where you can retire, or you will have choices to be able to do other things. So please use that 5%, make that 5%, but just know that's a temporary solution. The goal is to get your money moving so that it's in a vehicle that can actually produce income for you.
Yeah. And just a reminder that what we were talking about in these last two examples was not eliminate your debt and then start saving for retirement. This is not an this or that,
Right.
this, then that. What we were showing are examples where you are doing this and that because
Right.
time is your greatest asset.
That's right. Yeah, it's all about compound cycles. We're all born with around 15 compound cycles. My age of 50, I might have four, maybe five, maybe six left. Um, it would have been nice if I'd had some of this knowledge, obviously 20 years ago, when I could take advantage of those 15 compound cycles. Well, in truth, you probably would be talking to me now because I would own some island somewhere. But
Right.
but the key is take advantage of the compound cycles you have. Just because
Yeah.
you're starting at whatever that age is doesn't mean there's no hope. What it means is our decision making has to become better. If you're 50 plus years old and you want to put yourself in a position where you don't have to work for the rest of your life, you need to become more aggressive. Similar to what Phil has said, if you got a lump sum available to you, you want to make sure you get that lump sum in a position so that it's actually producing true income for you in the number of compound cycles that you have. If you're a person like a client that I had earlier this week, 19 years old, making $32,000 a year living at home, because he's living at home, he doesn't have the bills that someone traditionally would have. So he's aggressively trying to put himself in a position to where he can decide to retire by age 40, if not 45. So my point is take advantage of the compound cycles you have so that you can put yourself in a position where you have choices.
And you know what's crazy? Because we had that one live stream where we talked about the 15-year-old kid that reached out to you, right?
Mm-hmm.
That's so it's interesting that the age 15 would get brought up again tonight because you had a second 15-year-old that
Mm-hmm.
reached out to you
Sure
and
did.
you had a meeting with him and his mom, right?
Uh, and okay, we've been doing this for an hour 35. I got words. So high level on that example is, right. I didn't know he was 15, obviously. I had a client reach out to me, put time on my calendar, and he did mention in the chat, does he have to have a parent with him? So that implied that he was under the age of 18. But again, I didn't know. When I get on the call with him, we're talking through what MPI is and isn't, and I didn't realize his mother was sitting next to him. Well, it turns out his mother is also a life insurance agent. And I think what she was listening for those standard buzzwords that life insurance agents use to see what kind of, I'll call it scheme I was trying to get her son in. But that's not my approach. I build income. It's about cash and liquidity for me. So I think in the process of talking, she immediately chimed in and went, well, what about this? Similar to some of the questions that Phyllis was asking. Well, like she was asking, what are the guarantees? Hey, I understand this product is an IUL. What are the guarantees inside of an IUL? Because what I later learned was she has a whole life policy on her son. So she already has her son set up. She's already leveraging him
Mm.
because she has insurable interest. She's already leveraging him to do infinite banking and do other things. Again, she provides life insurance products. But
He's
when
a
I
million
broke
dollar baby.
exactly, but when I broke down what this product is, she got quiet. And she got quiet mainly because there's an opportunity here. There's an opportunity here that she just isn't able to provide to her son. And that opportunity is there's a vehicle that's a little bit better than a traditional whole life policy or a traditional IUL. So yeah.
What I just appreciate about that, and thanks for that feedback, Celeste, because sometimes I try to advocate for the people out there. I am not the insurance provider. I don't do what Donnell does. That's his lane. He's the expert. So I'm here out here just asking the questions and trying to make sure that people get the information that I think. So anyone's questions and feedback, whether you're watching the replay or you're here with us live, really helps us understand how to best help. Here's what I think is so dope. This guy is this is the second 15-year-old that's reached out to you. In what generation were you 15?
Right.
And you were so focused on being able to retire early that at 15 years old, when today's day and age, he could have been completely consumed with girls, right? Or
Video
games
games. Right.
or
Right.
sports or whatever the case is, or other things, right?
Right.
Alternative things.
Right.
He could have been, his mind and his focus could have been consumed with anything else. But these kids, 15, this is the second one now. This is a sign to me that this generation is like, oh, you could retire early. You could just not work for the rest of your life. Yeah, let me start with that plan. That is
Well.
amazing.
Well.
And I hats off to them, hats off to their parents,
Right.
regardless of if they agree or don't agree with their approach, because a lot of them are not wanting to go to college, right?
Right.
So
Right.
they're coming up with a plan like, hey, if I can become financially secure and I can get this plan in place, I don't even need to go to college and go through all of that because I'll be set for life. Still, that's amazing that they could even come up with that. They're like, follow me for more life hacks, retire early. That's so great, I think,
Well,
that
and I
they're
think
even thinking that way.
what's so powerful is how many 15, 19, 22 year olds are going to your neighborhood financial advisor and getting support.
Well,
Like
they
how
can't.
many exactly? how many financial advisors, licensed fiduciaries, are working with 15, 19, 22, 21, 24 year olds on helping them identify and how to showing them how to build their future. Like that's the part that I really do enjoy is it doesn't matter your age. What matters is, are you ready to decide? Similar to what
Yeah.
Cortland said, right? Kill off all of the choices and take action. And most financial advisors won't even touch a client of that caliber unless they are some type of $1 million baby already, right? Some type of trust fund kid. But for the most part, I think you're absolutely right. This generation is different, and I think people are realizing there's more to life than just that job that they have. So it's, what, how can I quickly get to a point where I'm producing income passively so that I can get to my purpose? Like I'm meant to be doing other things, and working for whatever that corporation isn't it. It's how can I get enough cash flow going so that I can fire this job and get to my purpose?
Yeah. That's that to me, that's completely incredible to even just consider that this is front line. Like this is on their list of to-dos. It's retire early and skip the line. We're
Right.
skipping the line nowadays. We're not even going to do it. No, get somebody else to do all of that. I know there's a different way of doing this. And just being able to say whether it's your purpose, whether it's you just don't want to do anything.
Right.
Okay. Whether it's I would like to game, whatever it is that you want
Yeah.
to do and spend that time that you can because you have tax-free income for life. But I think the piece that I think is the most important is time freedom. I think it's just the concept of watching people be chained to their careers, watching people miss out on raising their kids, watching people miss out on spending time with family, watching people miss out on even going to go see family that doesn't live near them.
Right.
Whatever it is, missing out on the world and what the world has to offer simply because we don't have the opportunity. We're limited for what we can afford and the experiences that we can afford. None
Well,
of
not
that
and
sounds
not
like a vibe.
right. And now you're going full circle because what is this about? This
Yeah.
is about taking control. And that means it's about getting self-directed. Being self-directed means you're taking control over what are those vehicles, those tools you're using to generate wealth. And in the process of generating wealth, what you're also doing is you're gaining more control over your time. Who, if you were to look in the mirror, who right now controls your time? Who tells you when you can or can't take off? Who tells you when you can or can't take that vacation? So becoming self-directed is about having control over your time. And then the last part is freedom. Putting yourself in a position to where you can actually have true freedom. And freedom is a very, very simple, there's a very simple definition around freedom. It's being able to do what you want, when you want, with who you want, whenever you want.
And why?
And again, so it goes back to
Yeah.
control. It's about control. Becoming self-directed is about taking control over those areas where you may not feel as though you have as much control over. And on that note, we need to go eat.
Yeah, and I was just going to say, because I think what they're seeing, especially this generation, they're seeing
Mhm.
that no matter how hard people work, everybody ends up poor. Everybody ends up without enough. And we have a solution to that. We have a ton of free resources. If you're looking to, how do I become self directed? Like, how do I get on board with this movement? We have a ton of free resources, and I'm going to show you how to get them. So, you ready?
Let's do it. Get
All right.
self-directed.
I'm Angelique.
And I'm Donnell.
All right. Now you can say it.
Get self-directed. You know what?
All
And
right. We'll
shout
see
out
you
to my
next.
camera for not freezing though. I just want to get that shout out.
Okay.
Shout out to my
Okay,
friend, my
Cannon.
camera for not freezing. So
Yeah.
that's what's
Okay.
up.
All right.
All
All
right.
right. Hang tight, guys. Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you get self-directed.